Hello and welcome to the Friday market update. Well, I have been out all week, had back surgery on Monday to replace a disc, and I'm about to head out to my son's Christmas performance. Can't wait, but I did not want to miss our weekly video. It was a bit of a rough week physically for me, but I'll be back strong next week. Now, on to the news. So a lot happened in the world of housing and the Fed over the past few days, and this is one of those weeks that will be remembered when we look back at how the 2026 market really started to take shape. So let's start with a big headline. The Fed cut rates again, 0.25%. That move was widely expected, but what surprised everyone was how strongly the Fed signaled that there could potentially be more cuts, very likely in 2026. The market responded right away. Mortgage rates dipped, but they came back up again a little bit. So Wall Street isn't quite convinced. They ended up this week around 6.3%. We were hoping for a little bit of a reduction in mortgage rates, but Wall Street continues to be very cautious on the inflation front. They're worried about inflation. Buyers who have been sitting on their hands are starting to wonder if waiting is the right strategy. And sellers who have been holding onto their homes like they are made of gold are finally paying attention to the direction things are heading. So right now, where you're seeing conventional rates in the low sixes, somewhere around 6.25%, 6.3%, FHA and VA rates are now below 6%, which is great. Not everybody knows that. Get the word out. And here's why I believe this matters. Once we break into the high fives on conventional loans, which I believe is very possible in the near term, we will see a psychological shift. Buyers react with emotion, way more so than the math. And a 5 handle just feels like a green light. This is exactly how we saw demand pick up at other points in the past whenever rates hit that magic threshold. We will see it happen again. When they dip into the fives, watch out. We're going to see a big rush in. Now, let's talk about what the Fed is actually doing here. They are responding to a softer labor market and inflation that continues to cool, but there are still fears that inflation will be sticky. Job growth has been negative in several recent reports. Inflation is holding steady instead of ticking up. We believe actually that we're going to see inflation decline in February and March of 2026 when some of the higher monthly numbers drop off. The way inflation is calculated, higher numbers drop. It's a rolling 12-month average. So I think we could see some decline in the inflation in March and February of next year. Now, jobs and inflation are the two things that the Fed watches more closely than anything else. Lower inflation plus weaker jobs equals a Fed that is comfortable applying a little more pressure on the gas pedal for the economy. And housing is one of the biggest areas where that shows up. Lower mortgage rates will absolutely spur the real estate market. So what does all this mean for 2026? Think of 2026 as a reset. We're pressing the reset button. The past few years have been like driving with your foot halfway on the brake and halfway on the gas pedal. Rates were higher, inventory was tight, buyers were nervous, sellers felt stuck, and the Fed kept pumping the brakes because they felt that the economy was running hot. Now the brakes are starting to come off a little bit, not all at once, but enough to get the car moving again. So mortgage rates are trending down, and they're down over 1% from January of just this year. Inventory is projected to rise as sellers re-enter the market, and there is a wave of pent-up demand that has been building for 3 years. We've had that steady 4 million home sales over the past 3 years. That demand does not disappear. It only waits for the right moment to take action. When rates dip lower next year, that moment arrives for a lot of people. I talk about it all the time. The median age of a first-time home buyer, 40 years old. They're getting old. They want in. Demand is on the sidelines, ready to get into the game. And now let me bring in something that really grabbed my attention this week. Pulsonomics released its new 5-year real estate appreciation forecast. It is a big report. This is a survey used in the Case-Shiller Index and one of the most respected long-term projections in the industry. The new report shows steady, moderate home price growth over the next 5 years of 20%, or about 4% per year. The survey is based on about 120 economists and real estate experts' projections. They compile them all. Nothing wild here. Nothing like the pandemic boom. Just good old-fashioned 4% appreciation per year at a national level. Now, here's what that means for buyers. Even modest appreciation can create serious wealth when you have time on your side. It's time in the market, not timing the market. A 4% yearly gain on a $500,000 home can stack up to more than $100,000 of equity over 5 years. And combine that with normal principal paydown, and you are looking at a meaningful boost in net worth. This is exactly why real estate has been one of the best long-term wealth building vehicles for families. You do not need double-digit price spikes for real estate to work for you. You just need consistency and time in the market. So here's something I want buyers and agents to really hear. The people who win over the next few years will be the ones who step into the market while everyone else is still talking themselves out of it. We have buyers frozen by fear through the data, though the data keeps improving. We have sellers unsure of their next move, even though the path forward is getting clear. And we have a Fed that is basically handing out a roadmap for cheaper money in the months ahead. That's going to happen. My advice is simple. Get ready, get educated, get excited, get your clients pre-approved, and get your game plan in place. Because when the market shifts, it does not send a memo. It happens fast. The buyers who are ready to win will win. The ones who wait for perfect clarity will be the ones saying, I should have done it earlier. They will regret not jumping in now, and some will have regret twice when they didn't buy during the pandemic either. We are also heading into the season of hope and fresh starts. It is a perfect time to talk with your family about your goals for 2026. Are you renting and ready for stability in terms of buying a home? Are you thinking about a move-up home? Do you want to build long-term wealth for your kids? These conversations matter. They set the stage for action. 2026 is a great year for that action. So that is the update for this week. The Fed is helping lead the way and soften the runway for 2026. Rates are easing. The long-term forecast is steady and healthy. And the window to get ahead of the crowd is opening right now. I'm happy to run numbers, talk strategy, or figure out how far your clients' buying power can go with the latest rate cut. Reach out anytime. I'm here to help you navigate this market and make confident moves. Well, I'm off to watch my son's Christmas performance. I can't wait to see him in his performance and singing the songs Jingle Bells. Wishing you and your families an amazing weekend filled with joy, hope, and maybe even a little early holiday magic. Hope you have a great weekend. We'll talk to you soon. Gaylord out.